Hello, my name is Bud DeRoy, and I'm doing a presentation on the cost and benefits of the flexible exchange rate versus the fixed exchange rate. Let's start off with the definition of exchange rates. An exchange rate is the rate at which one currency can be exchanged for another. In other words, it is the value of another country's currency compared to that of your own. If you are traveling to another country, you need to buy the local currency. Several years ago, I traveled to the Philippines, and when I was there, the exchange rate was 50 pesos for $1. It allowed you to buy quite a bit more with their currency. It's nice to see your money worth so much. History of flexible and fixed rates. Originally, the rates were fixed. They were set to the gold standard in each country. They tried to stay by that, but that was abandoned after World War I because during the war they had allowed their currency to devalue because they were just printing money to be able to buy more and to spend more. They continued to do that, and really was destructive to their economies. So then there was the Brentwood system. There was a group of 44 allied nations that got together, the United States, Canada, Western Europe, Australia, Asia, Japan, and they got together and worked on a policy. And they got together in a small little town in Brentwoods, New Hampshire, and they got there on the 1st of July and worked together until 22nd of July in 1944, which then they all came to agreement and they voted on it and agreed to it. Then they each took it to their countries to get it ratified. And it was ratified and established in 1945. It was the first fully negotiated monetary order intended to govern monetary relations between all the different countries, so that there was a rate and it kept the values, set. The currency was pegged to the U.S. dollar and gold, and since the U.S. had 2/3 of the world's gold, they felt that they should be the most logical choice to be the lead currency, which in case they did become. But then on August 15, 1971, the United States terminated convertibility of the US dollar to gold, and then basically rendering the dollar a fiat currency, which basically the definition of that is a currency which derives its value from government regulations or law. And of course, we have the Federal Reserve that controls our monetary policies and keeps everything in order. Now let's talk about benefits of flexible exchange rates, and there are quite a few of those. Let's start off with the first one: independent monetary policy. Under a flexible exchange rate system, a country is free to adopt an independent policy to conduct properly domestic economic affairs. The monetary policy of a country is not limited or affected by the economic conditions of other countries. It acts as a shock absorber. A fluctuating exchange rate system protects the domestic economy from the shocks produced by disturbances generated in other countries. Thus, it acts as a shock absorber and saves the internal economy from the disturbing effects from abroad. Promotes economic development. The flexible exchange rate system promotes economic development and helps to achieve full employment in the country. The exchange rate can be changed in accordance with the requirements of the monetary policy of the country to achieve the planned national objective. Solutions to balance of payment problems. The system of flexible exchange rates automatically removes the disequilibrium in the balance of payments. When there is a deficit in the balance of payments, the external value of the country's currency falls. As a result, exports are encouraged and imports are discouraged, thereby establish equilibrium in the balance of payment. promotes international trade. The system of flexible exchange rate does not permit exchange control and promotes free trade. Restrictions on international trade are removed, and there is free movement of capital and money between countries. Increases in international liquidity. The system of flexible exchange rate eliminates the need for official foreign exchange reserves if the individual governments do not employ stabilizing funds to influence the rate. Thus, the problem of international liquidity is automatically solved. In fact, the present shortage of international liquidity is due to pegging the exchange rates and the intervention of the IMF authorities to prevent fluctuations in the rate beyond a narrow limit. Market forces at work. Under the flexible exchange rate system, the foreign exchange rates are determined by the market forces of demand and supply. Market is cleared off automatically through changes in exchange rates, and the possibility of scarcity or surplus of any currency does not exist. International trade not promoted by fixed rates. The argument that fixed exchange rates promotes international trade is not supported by historical facts of interwar or post-war period. On the other hand, under the flexible exchange rate system, the trend of the rate of exchange is generally assessed in the forward market, and the markets are protected from financial loss rising from fluctuating exchange rates. This helps in promoting international trade. International investment not promoted by fixed rates. The argument that long-term international investments are encouraged under fixed rate exchange system is not valid. Both the lenders and borrowers cannot expect exchange rates to remain stable over a very long period. There are also costs of flexible exchange rates. Low elasticities. Elasticities in the international markets are too low for exchange rate. Variations to operate successfully in bringing about automatic equilibrium adjustments. When imports and exports elasticity is very low, the exchange market becomes unstable. Hence, the depreciation of weak currency would simply tend to worsen the balance of payments deficit further. Unstable conditions. Flexible exchange rates create conditions of instability and uncertainty, which in turn tend to reduce the volume of international trade and foreign investment. Long-term foreign investments are greatly reduced because of high risk involved. Adverse on economic structure. The system of flexible exchange rates has serious repercussions on the economic structure of the economy. Fluctuating exchange rates cause changes in the price of imported and exported goods, which in turn destabilizes the economy of the country. And we see that as the dollar becomes stronger, we have more imports coming in, and then as the dollar becomes weaker, then people buy from at home, from the domestic economy. Whereas now, as the dollar is getting stronger and stronger, of course, imports will continue to go up. Unnecessary capital movement. The system of fluctuating exchange rate leads to unnecessary international capital movement by encouraging speculative activities such as system-caused large-scale capital outflows and inflows, thus seriously disturbing the economy of the country. Depression effect of capital movements. Speculative capital movements caused by fluctuating exchange rates may lead to the problem of extremely high liquidity performance. In a situation of high liquidity preference, people tend to hoard currency, interest rates rise, investment falls, and there is a large-scale unemployment in the community. Inflationary effect. Flexible exchange rate systems involve greater possibility of inflationary effect exchange depreciation on domestic price levels of a country. inflationary rise in prices leads to depreciation of external value of the currency. Factor mobility. The mobility of various factors of productive deprives the flexible exchange rate system of its advantages arising from the adoption of monetary and other policies for maintaining internal stability. Such policies produce desirable effects on production and employment only when supplies of factors of production is elastic. Value of flexible rate system. Experience of the flexible exchange rate system adopted between the two world wars has shown that it was a flop. Benefits of fixed exchange rate. Avoid currency fluctuations. If the value of currencies fluctuates significantly, this can cause problems for firms engaged in trade. For example, if a firm is exporting to the U.S., a rapid appreciation in currency would make its exports uncompetitive and therefore may go out of business. If a firm relied on imported raw materials, a devaluation would increase the cost of imports and would reduce profitability. Stability encourages investment. The uncertainty of exchange rate fluctuations can reduce the incentive for firms to invest in export capacity. Some Japanese firms have said that the UK's reluctance to join the euro and provide a stable exchange rate makes the UK a less desirable place to invest. Keeping inflation low. Governments who allow their exchange rate to devalue may cause inflationary pressures to occur. This is because AD increases. Import prices increase and firms have less incentive to cut costs. A rapid appreciation. A rapid appreciation in the exchange rate will badly affect manufacturing firms who export. This may also cause a worsening of the currency account. Inflationary expectations. Joining a fixed exchange rate may cause inflationary expectations to be lowered. But we do know that a flexible exchange rate does drive down the inflationary number. Cost of fixed exchange rate. Conflict with other objectives. To maintain a fixed level of the exchange rate may conflict with other macroeconomic objectives. If a currency is falling below its band, the government will have to intervene. They can do this by buying currency, but this is only a short-term measure. The most effective way to increase the value of a currency is to raise the interest rate. This will increase hot money flows and also reduce inflationary pressures. And as we just talked about increasing the interest rate, we know that the Fed, has talked about doing it in September, now maybe the end of the year. But automatically, the first time when they thought it might happen, the value of the dollar continued to increase and become stronger. Less flexibility. It is difficult to respond to temporary shocks. For example, an oil importer may face a balance of payments deficit if oil prices increase, but at a fixed exchange rate, there is little chance to devalue. Joined at the wrong rate. It is difficult to know the right rate to join at, and we're talking about going from a flexible rate to a fixed rate. If the rate is too high, it will make exports uncompetitive. If it is too low, it could cause inflation. Current account imbalances. Fixed exchange rates can lead to current account imbalances. For example, an overvalued exchange rate could cause a current account deficit. Flexible exchange and fixed exchange rate solutions. Basically, it's determined by the type of economy, whether it's a developing economy or an advanced economy that's been around for a while. The developing economy, they're stronger if they're pegged their currency to a world reserve currency, such as the dollar, the euro, or the yuan. because they don't have anybody else that has a monetary policy for that money. The government drives it. They don't have a central bank, such as the U.S., the euro, etc. It gives them more stability. Advanced economies work better with a flexible exchange rate that flows with the markets and is managed by the central bank, which of course is the Federal Reserve. And they have their tools to control the exchange rate, such as the interest rate, buying of currency. These are things that they can do. They buy bonds. These are all things that they do to control the value of the exchange rate. It's interesting when we talk about this because it makes you think of China and how just recently they unpegged the yuan to the dollar. And initially they had this big descent, the stock market was crashing. And what they were doing, they were pegging it to be a flexible exchange rate so that it followed the markets, which is a big step for them because they're wanting to be part of the IMF and be part of the world currencies. So this is their first step, and actually they're doing what the IMF tells them to do. So when you see that, as you see a company that was pegged, a country, and they step out and they unpeg as they become more of an advanced economy, China basically takes this whole thing that we've discussed here and bundles it up and just shows you why smaller countries, the developing countries, start out pegged, and then as they become advanced, they become flexible because their currencies all over the world. So, and that's a summary and the solutions. Now I'd like to know if you have any questions that I can answer. It's been a pleasure sharing this with you. Here are the references. I look forward to hearing from you. Thank you.